Kitco News special coverage of the mining investment event of the North is brought to you by West Red Lake Gold Mines.
Hey everyone, welcome back to Kitco News. I'm Jeremy Saffron. We're coming to you all week long from the mining investment event of the North here in beautiful Quebec City. And as we look at the markets today, gold is back trading in a $3,300 to $3,400 band, and spot silver are currently holding at about $34, up about 18% this year. Now, the U.S. 10-year sits near 4.4% as traders and investors are waiting for what is arguably the most important U.S. data point of the month. We're going to get Friday's morning's May employment situation report from the Labor Department, and this data could sway the Federal Reserve. And on the trade front, policy risk remains front and center. President Trump has doubled U.S. steel and aluminum tariffs to 50%, and fresh rhetoric with Beijing keeps tensions quite high here. President Trump saying on Truth Social this morning that Chinese President Xi Jinping is extremely hard to make a deal with. Even so, global equities hover near record highs. On the official sector side, central banks added about 12 tons of gold in April, according to the World Gold Council, bringing year-to-date buying close to 85 tons. On the equity market, several juniors are showing relative strength. One of them, West Red Lake Gold Mines, and they just reported their bulk sample results as its 100% owned Madsen Mine supports a mine plan with larger stopes, higher efficiency, and lower expected costs. Now, to connect these macro moves with the project update, we're joined by Gwen Preston, of course, Vice President of Investor Relations at West Red Lake Gold Mines and a longtime analyst of the resource sector. Great to see you, as always.
Nice to see you too.
Okay, you heard that intro where there's a lot to get into here. Obviously, we got this breakout on the metals front. I mean, today, gold still responding high. I got to ask you, as we talk about these deficits in the U.S. government, as we talk about what the Fed's going to do, and obviously these geopolitical situations, what's the catalyst driving gold here? Is it still just central banks?
I mean, central banks are fundamental. The way I look at it is there's two pieces to this puzzle. There's the forces that have been in play for the last 5-6 years that I think remain completely in play. Central banks are absolutely a big part of that. So is, Asian buying, Middle Eastern buying. I mean, I think that those markets, those gold buyers, physical buyers, have been lifting the gold price despite complete dearth of Western interest over the last 5 years until about a year ago. And that hasn't changed. That situation remains completely in play. What I think the catalyst is, and I don't mean on a day-to-day basis. I have no idea. I can't pretend to understand gold on a day-to-day basis. But what matters to me on a big picture basis is that for most of those 5 years, Western investors were being given specific reason to not care about gold. There was a million other opportunities in the broad stock market. Tech stocks were racing, interest rates were rising or were high, all of the classic reasons to not care about gold. That's completely changed. And so now we're in a situation where Western investors are being given every reason to, maybe I should diversify. Maybe I should do that thing that we always do when faced with economic uncertainty and falling interest rates and all that, which is put a portion of my portfolio into gold. And so that's what I think the catalyst is. What I think is happening right now is that Western investors are rotating into gold, adding to that base that's been there for the last few years. And so that's that matters for the gold price. I think it also really raises interesting questions about what might happen for gold equities, because Western investors are the ones who, when they buy gold, also play the equities side of it, whereas those who were buying physical over the previous few years don't do the equity side of it. So that's the big picture, right. Again, on a day-to-day basis.
Yeah, you don't pay attention. I mean, some people do. One of them that is the World Gold Council just came out, and of course, central banks added 12 tons in April. It's a little bit of a pullback compared to the past 2 months. And I'm wondering, price being around $3,500 on the spot side, is that probably going to slow down a bit of buying?
You'd think. And they have been doing a lot of buying over the last few years. And so should we give central bankers credit for being price sensitive or price sensible? I'm not sure, but they have a bigger mandate, which is driven by de-dollarization, deglobalization. So at the end of the day, a lot of them are likely faced with a situation where they know they need to continue to stockpile, and they're going to try to be a bit reasonable about pricing as that happens, but the mandate exists nonetheless.
Yeah, Gwen, I know you look at the macro front a lot, and I just saw Trump was tweeting about too late Jerome Powell. You must be lowering interest rates because the ADP numbers came out today extremely low. Do you think anything will derail the metals bid on the data front? If we get any surprise data, you think that's going to do anything?
I mean, the only thing that could is data that surprises on the upside, so particularly strong. I mean, I don't, and I don't expect that. You can see from my reaction that that's not what I expect. Yeah. So no, black swans aside, I don't think so.
Yeah. Then of course we got this trade war, and of course it's heating up. I mean, Trump today, new 50% U.S. steel and aluminum tariffs. He called Xi extremely hard to make a deal with. Obviously, China's watching. I'm curious. Does the gold market actually care about this stuff? I mean, on the macro front, or is it just a headline noise at this point?
I mean, I think it plays back to that conversation we were just having about Western investors. So when we talk about generalist funds who operate, who change, who bring new themes into what they're doing, I think any increase in the trade war rhetoric, action, or risk. So, commenting that it's very hard, that Trump is saying it's very hard to make a deal with China, that amplifies that. Right. And so does that increase a large institution's interest in rotating to the theme of gold? I think it does.
Yeah, hard assets have obviously been a theme throughout the year. We continue to see people piling into them. I mean, GDXJ still trails gold by about 15% year to date. So I got to ask you, I mean, what unlocks the gap? I mean, what catalyst? Is it this sustained price that we're seeing? Is it M&A? What are your thoughts on that market?
Yeah, it's a very good question. I think it's happening slowly. I don't know if it takes a particular catalyst or if it's more just sort of the freighter takes a long time to turn. These generalist institutions that I'm talking about, they don't flip overnight in their thematic focus. I do think that the amount of money that major mining companies are making right now is ridiculous, in a good way, ridiculous. I hope that those companies put a bit more of that money into dividends, because I think if gold, as the gold mining sector can become a really attractive dividend space, that would only amplify the reasons for that rotation to happen. But yeah, I think it's mostly freighters take a long time.
Well, we've seen some of the majors take a little upside on the stock side. I mean, Agnico, for instance, with their all-in sustained cost being incredible. But I mean, the shareholder value to the shareholder, are they putting that back in buybacks? What are your thoughts? Just clearing out debt at these levels?
Yeah, so that's the other really interesting question, and especially for someone in my position. They have a lot of money. I mean, I don't love share buybacks personally. Everyone can have their own opinion on that. If it were up to me, dividends and then their project pipelines are getting fairly skinny. And by that I mean most of the major miners are good for the next 7 years, call it, something in that sort of range. Like things look good for 7 years and then it starts to tail off. But we all know that it takes 7 years often from when you purchase a project at some sort of reasonably advanced development stage to get it into production. So we're getting to the point where that's going to need to happen. And what I think is extra interesting about that comment, which is a comment that's existed for a long time, is that in the last 2 years, the middle section of the gold mining space has been hollowed out. So the single asset operators, the smaller mid-tiers, it's getting hollowed out. They're getting eaten up left and right, and there just are very few assets out there to fill that gap that's starting to really show up, or that tail off of production that's showing off for the majors starting 7, 8, 9 years out. So I think it's a pretty interesting moment for the slightly smaller companies in the space and going down from there.
Yeah, let's dig that open a little bit. I mean, let's get your temperature check on M&A. We've seen it. Some of these several deals have been announced last quarter, but juniors, I mean, they're still very cheap. So are they, the majors disciplined buyers here, or are they just buying ounces?
I think they're pretty disciplined buyers. I think that the lessons of the last bear market turn remain very. In fact, I think that the lessons of that experience are almost impeding M&A. I know we've seen quite a bit, but I actually think the M&A that we've seen has been pretty good. It's been pretty smart. I think it's been accretive. I think it's been sensible. I don't think we've seen anything like the kind of badly chosen M&A that we see when bull markets start to get crazy, which I like. I like to see deals that make sense. So no, I think those lessons, and that's why when these companies have oodles of money, they're using it to pay down debt, to buy back shares, and to some extent to dividends. They're not using it for M&A because they're still, if anything, extremely cautious.
Yeah, I was going to say that. I mean, you've seen even G&A costs come down, marketing costs come down. I mean, it feels like this time printing money might be a little different for those majors.
Yeah, absolutely, yeah.
Yeah, okay. Let's talk about permitting and policy. Obviously, we're up in Canada. There's been a lot of talk with the new Prime Minister here about opening up permits. Obviously, we've seen what Trump has done down in the South, making gold a strategic mineral. Have you seen any hard evidence, like actual talks, anything on this front?
Yeah, these things are always a little bit slow to play out. I mean, we have a secondary project. We're in Red Lake, Ontario. Our main mine is completely permitted. That's what that is. We have a secondary project that's just a little bit to the northwest of us called Rowan. That is something that we will push to be permitted. That's in our scope over the next few years. And so just last week, the president of Red Lake, the mayor is what I meant to say, of Red Lake, was visiting Doug Ford in his office, and they were talking about permitting and the potential for a project like Rowan to fit into the kind of new category that's being discussed, right? Special economic projects for expedited permitting. We'll see. I don't know. I don't think there's a lot of evidence of it. Yeah, it isn't really happening yet, but there is a lot of talk. Yeah. So where there's smoke, hopefully there's fire.
Hopefully.
So we'll see.
Yeah, I haven't seen a ton of months shaved off quite yet on the permitting side.
Not yet.
Hopefully soon, as you mentioned. Okay, let's talk a little bit more about West Red Lake. You just had this bulk sample takeaway. I want to talk about it because you got larger stopes, right, which is going to be very important for the efficiency of this mine. Of course, you have lower expected costs as well. You and I talked at PDAG, and you said it's a show me story. This seems like the steps to make it, I'm showing you.
Yeah, for sure. So I think, absolutely. So there's been a couple important steps in the show me process that we've put out in the last month. I mean, putting out the initial results of the bulk sample where we showed that what we expected from our model to mine lined up almost exactly with what we actually pulled out of the ground. That was the first really important step in, okay, our process works. The way that we model and then engineer and then mine this thing works. So that was really important. Then that was the last big check mark that we needed to put the mine back into production, which we did. And then we put out, like you say, just the other day, other learnings from the bulk sample process. And what that really referenced was starting slowly and, getting going mining really highlighted to us some things that we can do down there that we didn't necessarily know if we could do, things like blasting up against old stopes. We can do it, the rock is fantastic, and so that eases some of our engineering challenges, which is really nice. And then it also just really highlighted some of the efficiencies that we're starting to see. When we did our pre-feasibility study, our official mine plan, which was only in January, those studies use a 3-year trailing gold price. And so it used a gold price of just under $1,700 in deciding what part of the resource was economic to mine, to put into the mine plan. And that low gold price led to like a really selective mine plan with, in general, quite small stopes that requires the higher cost mining method and is not a highly efficient mine. And what we're seeing now, we get in there, we do the definition drilling to update our model. That definition drilling, in a lot of cases, highlights more high-grade gold than we saw in our resource model. And that's just the nature of these lenses. 20-meter spaced holes, high-grade lenses can slip in between those, go unnoticed. When you tighten it up to 7 meters, your odds of hitting the lenses increase. So we're defining the gold, the high-grade lenses better, and then we're engineering based on the long-term consensus gold price, which is $23.50. And the result of that is, in general, our mining shapes are bigger, they're more efficient, you can use long hole stoping, which is the lower cost mining method. It's all working out really nicely. So yeah, this is something that we've talked about and said that we expected, we hoped would happen at Madsen, but like you say, now we actually are doing it, and so we can put out the data and some evidence that it is happening.
Now, I've seen you busy. You've been on one-on-one meetings for this entire conference so far. What's the most misunderstood point about this update from investors so far that you can kind of get out there?
Yeah, that's an interesting question. I think Madsen is still a story that remains the show me story. We just did the bulk sample. We just started up the mine. We've just now put out this fairly significant piece of news about how it's a slightly different, a bigger, arguably better mine than what we initially said. So I don't think there's any one thing. It's making sure everybody understands the whole picture. This is, as we've noted, this is a mine that failed 2.5 years ago. We've pushed really hard for the last 2 years to address those things and set ourselves up for success. So now it's just, I talk really quickly in these half-hour meetings that I'm in to try and get through all of the story so that people can understand, there's the mine plan with its value. Then there's the efficiency that we've unlocked. Then there's the additional deposits that we own that are not yet part of the mine plan. Those are all potential additions. If you're trying to think about what West Red Lake could or should be valued as with Madsen as a producing asset, you have to consider these factors that layer on top of that PFS valuation. And so it's telling that whole story. That's really what my goal is.
Yeah, it almost feels like there's been some cost reductions on this front too. I mean, in terms of efficiency, right? I mean, Canada is a very expensive place to mine. It feels like you've got some unit cost reduction.
Yes, so for sure. The tangibly, the biggest benefit of those larger mining shapes, when you have the small mining shapes that are really just focused on those high grade lenses, you have to mine those by a method called cut and fill. Really, to just keep it simple, cut and fill is when you develop you develop sills below and above the thing that you're going to mine, and those are only about 4 meters apart. So the block of ore that you're mining is only 4 meters tall, quite a small block of ore. It's quite a bit of development for each ton that you're getting out. When you have a bigger mining shape, you can do long hole stoping where you develop your upper and lower sills at Madsen about 20 meters apart. So the number of tons that you can mine for the amount of access that you're doing, it's a much more efficient mining method. And so I think in that news release I included from our PFS the table that shows that the expected long hole stoping mining cost per ton is half of the expected mining cost per ton of that cut and fill method. So yeah, a real tangible benefit.
Yeah, and I mean, you know, the drill program is funded. I mean, it's operating kind of now.
Yes, for sure. And I mean, the drilling that we're doing is absolutely part of the operating cost structure of the Madsen mine, because what we always have to do at Madsen is keep ahead of ourselves with drilling. We have about a 20-month mine plan that's fully fleshed out, all the definition drilling done, the stopes designed. And so now we're working on months, 22 to 24, and then 26 after that, and we'll always be working at that end of the schedule. And what's really important about having done, call it 20 months worth of mine plan work, is that now we have that. You can call it mineral inventory ready, and as things evolve, if we need to move things around and play with them, it's ready to go. That's a really important, optionality is essential in mining, and we've done the work to have that.
Yeah, another essential thing is obviously your finance through 2026 in the drill season as well. I'm curious on the metals side. I mean, if the price is correct and they come down, say 15%, I mean, do you still got a runway without dilution?
Yes, for sure. So I mean, we expect that we have the capital that we need right now to continue ramping this thing up. We've got it into production. We're producing gold. We poured gold last week. Today's Wednesday. I bet we're pouring gold today. That's usually what the schedule is. So that's fantastic to be pouring gold, especially with gold trading where it is right now. If prices correct a bit, we do expect that we have the capital to continue to get this thing up and running. So that's super exciting to be a new high-grade gold mine in this gold market where there are very few new high-grade gold mines. I mean, the bear market that gold equities have gone through just means that not very many projects got to the point that we've been able to get Madsen to. So yeah, it's a rare thing to be starting up production right now, and it's very exciting. Very exciting.
Okay, last question. I got to get you to your next meeting. It's just a quick one. Gold above 3,400 year end?
I'm in. Yeah. Oh, year end for sure. Yeah. Absolutely. Yeah. I see no reason
corrections. We got lots of.
I don't know about no corrections. Yeah. Let's not pretend that things only go in one direction. But above 3,400 by the year end, I think so.
All right, Gwen. Appreciate it. Well done.
It's been very nice.
Thank you so much. I'm Jeremy Saffin for all of us here at Kitco News. Thank you for joining. We're going to be here all week long with some great guests, so stay tuned, and we'll see you next time.
Kitco News special coverage of the Mining Investment Event of the North is brought to you by West Red Lake Gold Mines.